Welcome. You're likely here because you've heard about this thing called a Roth IRA conversion, either from a colleague, from your advisor, or from a workshop you attended, and you still can't understand what it is or you need further clarification. Well, welcome. My name is Robert Martin. I am a chartered financial consultant and a partner at Zenith Retirement Planning, and today I'll be covering exactly this topic. To fully understand what a Roth IRA conversion is, you need to understand the difference between an IRA, a traditional IRA, and a Roth IRA. So the traditional IRA is your tax-deferred account. When you were working, you took some money, you put it into this account, and you never paid tax on it. And inside that account, it grew tax-free. And then when you retire or when you decide to take money out of that IRA, it's taxable then. So that's 80% of the money that we see. It's your 401k, it's your 403b, it's your traditional IRAs. And they're all tax deferred. You never paid any tax on this money. Of course, the catch is when you take it out, you pay tax on it. But then you have this thing called a required minimum distribution that is mandated by the government that at age 73, as of 2023, you must take out a minimum amount of that account. Why? Because the government doesn't want you to keep deferring paying tax to them forever. The other part is, if something happens to you or your spouse and the IRA is inherited by your children also have to pay tax on that account. So we call this account the IRA. We call this IRA the forever taxable account. Now, the Roth IRA is actually the exact opposite. The Roth IRA, you took some money and you put it into the Roth IRA and you paid tax when you did that. And the money inside of that Roth IRA grew tax-free. And then, because you already paid tax, when you take the money out, you don't pay any tax. But something else fantastic also happens here. The growth of that Roth IRA is also tax-free. There is no required minimum distribution. And when your children inherit that Roth IRA, they also don't have to pay any tax on that account. So we call this the forever tax-free account. Now, for that reason, between these two, the tax nature is different. A lot of people want to find out how to get from an IRA to a Roth IRA. But in our industry, there's two words that tend to get floated around that are very confusing. When you're working, you're given the ability to contribute to your employer-sponsored 401k. You're given the ability to contribute to a traditional or an individual IRA or a Roth IRA. When you're contributing to an IRA, the limit's usually about $6,000. If you're over a certain age, it's $7,000. Now, there are rules on contributing to both of these accounts. If you make more than $200,000 as a married couple filing jointly, you're not allowed to contribute to a Roth IRA. So, a lot of families believe that the Roth IRA option is not even on the table for them. But it's actually not true because there's a difference between contribution and conversion. A conversion is when I'm taking money from an IRA that's already in an IRA and I am transferring it directly to a Roth IRA. And when you do that, you must pay the tax on the way through. But you've changed the tax status of that account. So a lot of people, for that reason, want to get from an IRA to a Roth IRA. They do it by converting money. And there's no limit on conversion. There's no age limit. There's no income limit. There's no limit whatsoever as it stands today in 2023. And we deem it the ultimate savings tool for that reason, because of the ability to take tax-deferred money that's going to be taxable forever and make it tax-free forever. But let's play devil's advocate here. To truly understand the benefit of a Roth IRA, you need to understand what happens to your IRA while you're living. So let's say all of your retirement accounts, that's your IRA, your 401k, your 403b, you decide to keep them and never hop on the bandwagon that is Roth IRA conversions. So you keep going the path you're going. Let's say you have $500,000 in your retirement accounts. Well, at some point, the government's going to tell you you have to take X amount of dollars out of your retirement account because We want you to pay tax revenue now. And as of 2023, that age is 73. Well, from 73 until you pass on, you must take a pound of money out and pay tax on it. So let's say that's happened and you're paying 20%. What kind of tax bill would you pay from that happening? Well, we estimated about $150,000 of tax. However, it doesn't stop there. Let's say that you have plenty of money and that RMD is simply extra money you don't need. Or it's money you could use, but you're going to reinvest it temporarily so it can grow while you're waiting to use it. Well, that's 99% of Americans. So if that's you, then you're in this next scenario. What happens to the reinvested RMDs? What happens to the growth? Well, you have to pay taxes. So we've estimated by reinvesting your RMDs, you're going to pay an additional $76,000 on top of the original $150,000. Next, let's say that you pass on and your children inherit your IRA or your 403b or your 401k. Now, it used to be, if you inherited an IRA from mom or dad, you're given 3 options on how to take the money out. You could take it out all at once, over a couple years, or over your lifetime, which could have been 30, 40 years of paying tax on this amount. But they changed that, actually. They changed that because of the Secure Act of 2020. You can no longer stretch out all that money over 30, 40 years and pay tax on it. Now, you have 10 years. So if you inherited money after 2020, your 3 options are take the money out all at once and pay tax on it, take the money out over a couple years and pay tax on it, or take the money out over 10 years and pay tax on it. So by the time this money gets to your beneficiary or your children, what kind of tax are they going to pay? Well, we've estimated about $130,000 of tax. So let's look at it all together. On a $500,000 IRA, at 20%, $357,000 was lost to income taxes. Terrible, isn't it? But let's say you decided that you're going to convert your money to a Roth IRA. So that $500,000, you pay 20% once or over a couple years, because you don't have to convert your money all at once. You don't have to take all of your IRA money and put all of it into a Roth. You can take some of your IRA and put it into your Roth and do that every year for a couple years. You'd pay approximately $100,000 on that conversion. So you'd have about $350,000 of your $500,000 left sitting in your account. Now it's growing and it's growing. But the good news is all that growth is tax-free now. You don't pay tax anymore. And then something happens to you and your spouse and your children inherit the money. But they don't pay any tax anymore because you have the Roth IRA. So the total taxes paid by converting to Roth is $100,000 compared to paying $357,000. Side by side, it makes it really easy to start writing the check. So that is what a Roth IRA conversion is. That is the benefit of doing a Roth IRA conversion from an IRA. And it is highly suggested that you talk to your team of professionals, talk to a tax professional, talk to your CPA about the logistics and how specifically this happens and what you can do to decrease your tax once you've already done the conversion. Thank you for joining me for this discussion on what is a Roth IRA conversion and what are the benefits of doing one. I look forward to being with you next time.